Okay, good afternoon, everybody, and thank you for joining this Invest Engine webinar in partnership with ARK Invest. My name's Andy Prosser. I'm the Head of Investments at Invest Engine, and I am extremely lucky today to be joined by Cathie Wood, who is the CEO and CIO of ARK Invest, and who's really at the forefront of investing in new technologies. So, Cathie, thank you so much for joining us.
Oh, my pleasure, Andy. I'm very, very happy to be joining you.
Now, in terms of the plan for the webinar, I've got a few questions which I prepared to ask Cathie, but we'll also be picking questions from the audience as well to answer at the end. So if you do want to ask Cathie any questions, just click on the little kind of Q&A button in the bottom of your screen. The questions won't be broadcast to the whole webinar chat. They're just going to come straight to us. So don't worry if you think you've got a stupid question, that's absolutely fine. Feel free to ask away and we'll answer as many as we can at the end. Now, it's my job to make sure that everything runs on time. So the initial Q&A should last kind of 30, 35 minutes, something like that. And then we'll have kind of 10, 15 minutes at the end for questions from the audience. So I'm hoping that once we've wrapped everything up, we'll be ending the webinar at about 4:45. Now, just before we dive in, one final point. I need to mention the usual disclaimer that your capital is at risk whenever you invest. This webinar is for UK clients only, and that none of this is financial advice. So with that, let's get stuck into the first question, Cathie. And my first question is actually, it's a bit of a two-parter. So first part is how all the kind of various areas of technology are converging. So there are many different investment platforms. You've got robotics, cryptocurrencies, AI, and they aren't just evolving independently, but they're kind of converging now. So how do you see this convergence affecting the investment landscape today, especially given all that's going on in the market with all the uncertainty at the moment? That's part one. And the second part of the question is kind of, while we're talking about this changing geopolitical landscape, could you also please give us your thoughts on this, the kind of chaos that we've seen in markets over the last couple of weeks, please?
Sure. Yes. Okay. So you can see from this slide how we see the 15 different technologies converging out there. You can see from the thickness of the line that neural networks or artificial intelligence is the biggest catalyst for change out there. It's impacting every technology and speeding up the rate of change. And at ARK, we have set up our analyst responsibilities not by sector or industry or sub-industry, but by these technologies that we think are going to scale across sectors as these convergences take place. Innovation gains traction during difficult times. We know that consumers and businesses, when they are worried, when they are concerned, they're willing to change the way they're doing things. They're looking for better, cheaper, faster, more productive, more creative for products and services. And so innovation actually gains traction during tumultuous times. We are in one of those times right now with the tariff turmoil. And how do we think that's going to play out? I know that from your point of view, on the other side of the ocean, that what's going on in the US seems very chaotic. And by the way, the same is true on this side of the ocean. It is very chaotic. And President Trump has a peculiar way of negotiating. And we've thought from the beginning he was going to use tariffs as a negotiating tool, certainly from the point of view of immigration and drugs like fentanyl. And we think there's a lot more negotiation going on behind the scenes than anyone now appreciates. We believe that at the end of it all, that the best case would be for all tariffs to come down, and for non-tariff trade barriers to come down. And we think that is a lot of what's going on behind the scenes, particularly the latter one, non-tariff trade barriers, just countries not allowing US goods at all into their countries, or putting such high tariffs on, there's no use even in trying. Now that might be wishful thinking, but here's the basic operating assumption from the beginning that we've been using. We know that President Trump grades himself on two variables, on the economy, growth and employment in particular, and on the stock market. And both of those are being roiled right now. I think what he's doing is getting the tough medicine out very early in this second administration so that by the midterm elections, which are next year, but the campaign season starts later this year, by the beginning of the campaign season, we will be back on a positive growth trajectory, and the stock market will be looking up. One of the reasons we believe we will be on a positive growth trajectory is the way we've been looking at this last 3 to 4 years. If you examine the numbers underneath the GDP growth, what you will see after the interest rate shock of 22 was one sector after another falling into effectively a recession. The only two sectors or parts of the economy holding GDP up were high-end consumer spending and government. High-end consumer spending is now starting to capitulate. I'm sure you've been reading about all the luxury retailers and the troubles they're going through right now. And government, we believe, is in the US, is in its first recession in 30 years. There are a lot of inefficiencies that have built up since Newt Gingrich and Bill Clinton moved the US into a surplus situation from a government point of view. And we think cleaning house is the right thing to do. It will give the private sector more room to grow, especially if part of the solution is not only cutting spending, government spending, but deregulating massively. And we're beginning to see that.
Fascinating. Just on this kind of slide that you were talking about before, I think it's really interesting how these are all kind of, they're not operating in silos anymore. They are reinforcing each other in real time.
Mm-hmm.
I want
Yes.
to dive into a specific part of that, if you don't mind.
Of course.
Talking about AI.
Mm-hmm. Yeah. Okay. Here you can see the areas that we think are going to be profoundly changed because of AI. The first is autonomous driving. And here you can see Tesla's full self-driving performance. By the end of this year, we believe, thanks to AI, that robo-taxis, or at least Tesla's robo-taxi, will be safer than a human driver. Human driver has an accident every 700,000 miles on average here in the United States. Waymo on this chart you see is about 400,000 miles, so it's not there yet. It is geofenced. Its latest reading is 500,000, so it is improving rapidly as well. So this is the year of autonomous driving. Waymo really paved the way, so to speak, broke down a lot of regulatory barriers. We think that Elon Musk, as part of this administration, or at least working closely with this administration, is going to move the regulatory framework from state by state, so 50 different regulators, to federal. So that's what we mean by radical deregulation. And we do think that by the end of this year, the robo-taxi concept here in the United States, again, because of deregulation, is going to be very well accepted. And we're going to be thinking about transportation in a very different way, moving away from prepaid transportation, which is effectively buying a car, into pay-as-you-go, with the cost coming down over time. The second area where we see AI making profound changes, this is the most profound application of AI, is healthcare. Recursion therapeutics is an example of how much AI is changing drug discovery and development. And you can see within 1 year, these are actual numbers, the number of hypotheses a researcher could test at Recursion Therapeutics has gone from 20 per year to 200 per year. And we think that that is going to go up from there, especially as we move into more agentic AI solutions. And then what we all know about, I think the first application of AI was not just our writing, of course, but coding. And here you can see what has happened in AI software engineering in effectively the last year. Given a prompt, sight unseen, this AI software engineer, so to speak, could complete only 4% of the task a little more than a year ago, and now can complete 72% as of when we drew this chart. I think we are approaching 80% now. So the productivity gains in coding and software engineering are pretty astounding, and the productivity gains in all of our lives as we harness these AI tools is going to make us superhuman effectively relative to what we believed was possible not even a year ago. And here you can see again, I just showed you a rendition of the chart on the left. Here is how we think AI is reshaping software. And if we were to redo this chart today, this is from our Big Ideas 2025. So the chart was done late last year. You can see AI, we believe, is going to accelerate spending in each area of the tech stack. So infrastructure layer, platform layer, and application layer or software as a service layer. You can also see on the bottom part of the chart how much share the application layer has lost to the platform as a service layer, and what we expect going forward, even more of a share shift. If I had to change this chart, it probably would be to make that acceleration faster and make the growth rate of software as a service perhaps slower. If we're listening to Elon Musk, he thinks software as we know it is going to disappear. We don't think it's that radical, but the advances in so-called agentic AI are so powerful that we do believe the productivity of engineers within each company is going to allow for much more customization company by company and less software as a service. Here is how you can see on the right-hand side our take on AI software encroaching on knowledge work labor. You can see currently where we are, and you can see growth in each of these modest, accelerated, or rapid mass adoption scenarios. So there's still growth, but much less knowledge work labor under the rapid mass adoption scheme here. And this again, this is translating into what we believe are going to be massive productivity gains across the global economy.
Hi, sorry, I'm just being told I've got microphone problems. Can you hear me okay, Cathie?
Yes, I can hear you.
Okay, good stuff. Yeah, I think that slide is a particularly fascinating one of my favorites, I think, from the deck. Just really interesting to see how AI could free up so much human capacity, especially in knowledge work. But maybe if we move kind of onto the physical side of automation and talk a little bit about robotics. Robotics are kind of starting to move from the factory floor into our homes, into our shops, into our restaurants. What breakthroughs do you think are going to be kind of bringing the next wave of adoption? And do you think that some combination of AI and or robotics is going to be causing big displacement in the jobs market?
Yes, what we do, what you see here is what happened when the tractor was invented, the first kind of robot out there. That at least that's what people were thinking about them at the time. And there was a great fear that there were going to be was going to be massive job losses, and as you can see in the farm worker world, yes, there was a big drop in employment. But guess who who uh, who left the farm? Those family members who basically earned room and board and nothing much more. They were able to go out into the workforce and get jobs in the Industrial Revolution. So we think the job loss is exaggerated out there, even in our own homes, for example. And I'm not sure if we have this slide in the deck. No, we don't. But in our own homes, um, we spend a lot of time preparing meals, cleaning up after meals, and so forth. That is unpaid work that we can activate robots to do in the future. And if we're right, that's a $250 billion revenue opportunity from a robotics point of view. Yeah, and here you can see that we believe that the generalizable robotics or humanoid robots represents a $26 trillion global opportunity, half in the household, half in manufacturing, as you see here. And what's interesting about this robotics idea is that there are broader applications. So if we think about robotaxis, that's the convergence of robots. Robotaxis or autonomous vehicles are robots. Energy storage, they will be electric, and artificial intelligence, they'll be powered by AI. Those same platforms are powering the humanoid robot moves as well. And here you can see ride hail, what a massive market opportunity we see there. $10 trillion in the next 5 to 10 years, half of that going to the platform providers. And you can see why this is going to happen. The cost to drive or to be transported by robotaxis is going to drop dramatically. So here in the United States, Uber is charging anywhere from $2 to $4 per mile. And with surge pricing, sometimes more than that, it's getting ridiculous. Obviously, that's not a scalable solution. But as Tesla and Waymo start pricing their services, they're going to start dropping below Uber and Lyft and continue to fall. If Tasha Keeney, our analyst, is right, the ultimate price at scale, so when a fully global robotaxi network is scaled out, will be 25 cents per mile compared to that $2 to $4 per mile. And this is the history of technology. It rides down learning curves, which are expressed in cost declines, which are passed through into price declines. And that's why these technologies scale.
So it sounds like that kind of convergence of AI and robotics is going to be a really powerful combination for investors.
Yes.
The next topic I wanted to touch on is energy. Obviously, none of this happens without energy. So changing tack slightly, spending a bit of time on that. Energy production, obviously crucial for growth, especially in this AI wave. Which parts of the energy space have you been watching and researching and why?
Yes, well, nuclear, here you go. We actually have been studying nuclear. Brett Winton, who's our chief futurist, and I worked together at our prior firm, and we wrote a big black book on it in 2010. And then, of course, Fukushima happened in 2011, and the environmental movement turned against nuclear. But if you look at nuclear, it is the cleanest energy source out there and the safest, as we elucidated in that report. What happened to nuclear, unfortunately, in the US and Japan in particular, was a wave of regulation which changed the cost dynamics dramatically. So you can see how much US electricity prices dropped from 1893 in the US into the early 70s. Very rapid drop. This was a new technology and it followed a learning curve. Then you can see on the right-hand side what happened with regulation. The cost to build a nuclear plant exploded. And the consequence is that electricity prices today in the US are 10 times higher than they would have been had nuclear continued to follow this cost curve decline. So we're doing a lot of work right now on how quickly we can get back on track. There are companies like Oklo out there, which Sam Altman is behind. Sam Altman, the CEO of OpenAI, really believes that small modular reactors are going to get us back to that cost curve, which would be phenomenal if it happens.
Yeah, that's an amazing stat about the energy difference in cost if nuclear carried on its trajectory. Fascinating.
Absolutely.
Yeah, turning away from energy, I'm keen to get your thoughts on blockchain as well. We've got a lot of different topics to cover, so I just want to pick your brains on everything. There's a lot of noise in the crypto space at the moment. So what do you think makes these public blockchains such an interesting platform? And kind of tying into that, how does Bitcoin factor into that equation?
Sure. I like to explain what's going on here. It seems so I guess the word crypto makes this movement seem a little suspicious and worrisome, and I get that. We should be using internet financial system or finternet, because all that's happening right now with blockchain technology is developers are building the layer of the internet that they did not put in place in the early 90s because they did not understand that financial services and commerce would take place on the internet. And so they kind of used band-aids with traditional credit cards and everything. And we have a permanent 2.5% to 4% tax on financial transactions and commerce. This layer of the internet is going to obliterate a lot of that tax. And we do believe that Bitcoin is the biggest and will remain the biggest part of the blockchain movement because for three reasons. It's a global monetary system, rules-based. If I've never seen a private, no government oversight, digital, decentralized, rules-based monetary system. It is a new technology, as I just described, and it is a new asset class, which doesn't behave like other asset classes. So any asset allocator has to take a look at a new asset class and have a point of view. Even if they don't like it, they have to have a good reason not to like it and not to incorporate it into portfolio. So what you see here are bear, base, and bull case for Bitcoin based on those three revolutions that are taking place. You can see we've segmented out what share of these various categories of use cases Bitcoin will reach, we believe. And I will say, because of the new regulatory regime in the US specifically, we are leaning more towards our bull case price target for Bitcoin than to our base case. And just to tee it up a little bit further, we wrote our first blog on Bitcoin in 2014. We took our first position. We gained exposure for our clients, our first position in 2015. That was when we wrote our first white paper on Bitcoin. It was $250 then. It is about $85,000 now. And yet, as you can see here, we believe there are miles to go for the various reasons. Institutional investment is a very big one, that purple part of the bar, and digital gold. Recently, gold has taken off relative to Bitcoin, but if you look at what happened last year, it was completely the opposite. And we do think over time, Bitcoin will take more and more share from gold because it is digital gold. And then the third use case there, that red part of the bar, that's really emerging markets. And this use case might be the most provocative because We do know that in many countries, corrupt fiscal and monetary regimes have destroyed purchasing power and wealth for their populations. Well, now, if a person in any of these countries has an internet connection, that person can buy an insurance policy in the form of Bitcoin against their possibly corrupt regimes.
Yeah, it sounds like there's real potential in that kind of, I don't want to call it crypto space anymore. What did you call it?
Well, internet financial system, Finternet, but
Internet, that was it. Yeah.
also, yeah, Finternet brings it to life more in terms of the technology. But digital assets, so crypto is evolving into, from a semantic point of view, a digital asset story. And DeFi, so decentralized financial services, that sounds very defiant. And when it started, it was very defiant. Now that's what we would call more the Finternet.
Hmm. Now we're kind of coming towards the end of the formal Q&A. If you're watching this live, do feel free to keep the questions coming in. I can see we've got lots coming in already. But my final question before we open up to the kind of audience Q&A is more human focused about medicine. So in healthcare, we've seen amazing progress in kind of gene sequencing, gene editing, that sort of thing. So how close do you think we are to seeing this kind of precision medicine going mainstream?
Well, we think that AI is pushing us very close. We're very close, and it will be much sooner than I think many people recognize. Here you can see AI feeding 4 areas of what we call multiomics. So multiomics means DNA, RNA, proteins, epigenetics, methylation. It's complicated. And you can see AI is changing the rate of progress in each of these areas. The tool space, molecular diagnostic tests, being able to identify and diagnose cancer in stage 1 or before stage 1, think polyps, with blood tests, tumors and polyps shed into the blood. And with sequencing technology and AI converged, we are beginning to identify cancer in its earliest stages, even pancreatic cancer. And then drug development, we think the timeline to develop a drug is going to shrink from 13 years to 8 years and keep shrinking thanks to AI. And we think the cost is going to drop from 2.4 billion per drug, including the failed trials, to 600 million. So it's going to transform healthcare back into the golden age, which is where I started my career when Genentech came of age and launched the biotech movement. And then finally, and maybe most provocatively, curing disease. As you mentioned, gene editing is already doing this. CRISPR Therapeutics is a company that's already curing sickle cell disease and beta thalassemia. But we expect more cures to evolve faster thanks to the convergence of sequencing technologies, AI, and CRISPR gene editing. So pretty excited about that.
Yeah, I think that's a really promising and kind of uplifting way to end the formal session of the Q&A. Before we dive into questions, though, I should mention that we have ARK ETFs on the Invest Engine platform, which capture all of these trends that Cathie's been talking about today. So we have the ARK Innovation ETF, we have the ARK AI and Robotics ETF, we have the ARK Genomic Revolution ETF, as well as plenty of others as well. So if you do want to find out more about them, all you need to do is go into the kind of browse investments page of Invest Engine, filter by ARK, or you can click on the ARK tile at the top of the actively managed collection. You can find them all there. Right, we've now got about 15 minutes, perfect timing to go through some questions from the audience. So let me just bring up my screen and see what we have from the audience. Okay, let's take this one then. So there's a couple here. I can try and group them together. We've talked quite a lot about themes in general up until this point, but how do these themes kind of flow through into the portfolio construction process for the ARK ETFs?
Yes, very important to understand is what we do not do. We do not use any benchmark as a screen for our ideas. Our screen is our research, and we give our research away. Many people are surprised to hear that, but we do it for a good reason. These worlds are moving so quickly that if we're wrong in any of our assumptions, we want to know as quickly as possible. And believe me, when you put your research over social media, you learn where you might be making mistakes, or you certainly learn where the controversy is in whatever we're saying and doing. So the stocks are a function of our research. By the way, this is Back to the Future. This is when I started at Capital Group in the early days of my career. This is exactly what we were doing, and we were trying to figure out how the future is going to work, not how the world has worked, which tends to be represented very well in traditional benchmarks. So we have both that top-down point of view, which is sizing a market based on the learning curves and how quickly costs are falling. And then our bottom-up research is very stock-specific, company by company, getting to know the management teams, getting to know many more of the people within a company, because we're out there talking to those in the field innovating, and they are feeding us back information that is quite important. It's not inside information. They don't have that kind of information. It's more technological, and where we may or may not be mistaken in terms of how quickly things are happening. So we have a 6-metric scoring system which includes management, sort of management, people and culture, execution, moats, barriers to entry, product and service leadership, valuation, and thesis risk, with which scoring each of the names, it is very easy to see how the portfolio should be arranged from a construction point of view.
And what's the kind of balance between quantitative measures versus qualitative?
So if we're looking at the top-down work, that is all quantitative, because each technology submits to a different learning curve. We have something called Wright's law, which is a relative of Moore's law. So that's all quantitative and very methodical. Bottom up, the first 4 scores are quantitative, meaning the score. It's a score. The valuation step of the process clearly is quantitative as well. But important to understand is our portfolios sell typically at a premium to the market, say the S&P 500. And our working assumption is that premium is going to compress to nothing, no premium to a market multiple within 5 years. So our analysts have to believe that revenue growth and margin expansion is going to overwhelm valuation compression and deliver a minimum 15% compound annual rate of return over the next 5 years. And I'll give you a sense now. Our portfolio, in terms of valuation, has rarely been at this narrow a premium to the market. It's within 10% based on adjusted enterprise value to EBITDA that we have derived with S&P 500 for innovation-based companies.
Interesting. Diving into the next kind of set of questions, I'm trying to group them together. We've got a couple on Bitcoin here. One person's asking, how do you value Bitcoin, given that it's got no yield, no central government backing, no assets? Is it just a proxy for global risk appetite? And then alongside that, why do you think, what's kind of preventing Bitcoin from taking that next step up? Because it's kind of been around the 80K range for a while.
Yes. So a couple of things. There were a couple of questions there, so let me place them again. So the way we get at that 1.5 million in our bull case is through the percentage assumptions. If we could flip back to that chart, maybe the percentage assumptions that that are behind each of those layers of the bar. Maybe we can't get back to that slide. And we think they're pretty conservative. Yeah, here we go. So you can see institutional investment. We think with the deregulation in the United States, the base case, 2.5% of allocation in a broad-based portfolio to 6.5%. If we are right that this is a global monetary system, a technology, and a new asset class, we think it could get up to that percentage. And so, of course, we're able to size each one of the markets you see here. And with this percentage, apply it to the Bitcoin price. And that's how we've gotten to these numbers. Is it just a risk-on asset? No, it is not actually. Just like gold, Bitcoin does not have counterparty risk. Certainly, that at that layer one part of the Bitcoin blockchain, and it has never been hacked at that level. Applications on top have been hacked, but never the base layer. And that's what you want for a global monetary system. It's a very big idea. When I first presented the white paper to one of my professors, Art Laffer, from college days, he's a monetary scholar, and he said, "Oh my gosh, this is what I've been waiting for since the US closed the gold window in 1971. So very big idea, and that it could become a global reserve currency, just like the dollar is. And then if you look at its behavior, one of the reasons we moved in very carefully in 2015, I believe that there was another flare up in the European sovereign debt crisis, and we just happened to note that every time there was some news out there, I think Greece was threatening to leave the European Union, and Bitcoin actually increased. And so there was this risk off dynamic taking place. The same thing happened during the regional bank crisis here in the United States. Bitcoin was the first big asset to move, and stocks followed behind it. So yes, it is a risk-on asset because this is technology, next generation internet, the finternet, in moving. So that's risk-on, and we certainly have that. But there are these risk-off dynamics or attributes that are also very helpful in developing confidence in Bitcoin.
Mm. Is that Mr. Laffer of the Laffer curve fame, or do they just happen to share the same?
Yes.
It is.
Yes. Actually, I was at a dinner that he hosted the other day, and I don't know if you've seen the movie Ferris Bueller's Day Off.
Of course, yeah.
Well, they showed the clip where all the students are just horribly bored as this professor is, going on and on and on. And they mentioned the Laffer curve there. I don't think the students piped up even for that, but it's very exciting.
Now, one thing we haven't touched on in this presentation so far, which does get talked about quite a lot in the kind of emerging tech space, is quantum computing. Do you have any thoughts on quantum computing? Does that feature in your portfolios at all?
Our chief futurist is this is one of his remits. Make sure that we are involved with the next big thing, within a relevant time horizon. We've done a lot of work, especially after Microsoft's biggest breakthrough. For the past 20 years, both he and I have been saying, okay, quantum computing maybe is 20 years away. Every year we've been saying that. I think maybe we're willing to narrow that a bit to 15 years because there are some breakthroughs here. But boy, do we have a lot of wood to chop, so to speak, before it really becomes relevant and commercializable. So very much in the research phase right now.
Yeah, that makes a lot of sense. Thank you. Let's have a look. What else have we got here? Okay. How do you balance kind of conviction in your thesis with the need to adapt to changing data, changing macro conditions? I guess that's very relevant at the moment, right? Lots of things are up in the air at the moment. How do you kind of balance your conviction against the kind of tide that we're seeing at the moment?
Yeah, when we get into a difficult market, what we do is that we concentrate our portfolio towards our highest conviction names as measured by that scoring system. and which is a bit contrary to what you hear from other portfolio teams who diversify to get closer to their benchmarks.
Mm.
We are benchmark agnostic. We're just really trying to figure out how the future is going to play out. So we concentrate towards our highest conviction names. Why do we do that? Well, if everything is getting hit, baby out with the bathwater kind of environment, then let's pick up the baby. Let's make sure that we've got our highest conviction names in the portfolio and that they are weighted aggressively to reflect our conviction. As a bull market evolves, we actually diversify our portfolios. Why? Well, a lot of IPOs are coming out, and we're going to be all over those. They tend to involve our new technologies, and so there's a lot more choice, and we revisit ideas as well that we've concentrated away from, because we could be wrong, or we want to make sure that that we've kept up with the latest developments as they are evolving their technologies. So one thing to understand with our portfolio, this is very important, the volatile portfolio. It is not meant to be the entire equity allocation for anyone. Save myself, by the way. That's all I have is innovation, both in the public and the private markets in my portfolios. But most advisors would advise against that. But is it 1% of what we often see is, a 1% position to extending to 5%, because this portfolio is a good hedge against the possibility that the traditional world order is going to be disrupted. The overlap of our names with the traditional benchmarks is very low, less than 10%, even vis-a-vis the NASDAQ. And yes, here you can see two ways that we're summarizing the opportunity here. The first on the left-hand side is where we expect the market to go, in terms of market cap growth rates. You can see from 2019 to 2024, the Mag 6, which is the turquoise, tripled in market cap, whereas innovation, as represented by purple, went up maybe 30%. And that's because earlier stage companies have been disadvantaged as this market concentrated very aggressively towards the Mag 6. But as you can see, going forward, we expect the Mag 6 maybe to quadruple, but the really disruptive innovation companies to go up more than tenfold in the next 5 years. And you can see the difference in the kind of return. And one of the other things that's going to happen is here on the right-hand side, real GDP growth. The history of technology breakthroughs is they lead to step function increases in GDP growth. You can see from 1500 to 1900, not much change. So real GDP growth, roughly 0.6%, as best as Brett Winton, our chief futurist, could make out from academic studies and so forth. But then in 1900, we were dealing with telephone, electricity, internal combustion engine, really transformative technologies that jumped that GDP growth rate up fivefold to 3%, where it's been for the last 125 years. Now, over the next 5 years, we would expect that growth rate to more than double, based on the convergence of technologies that you showed at the very beginning. And we think that's somewhat conservative, given that we've got 5 major innovation platforms, so robotics, energy storage, AI, blockchain technology, and multiomic sequencing. So 5 major platforms evolving, involving 15 different technologies, compared to only 3 major innovation platforms evolving in the 1900s. And we would expect the growth rate to accelerate from there. This is quite a controversial number, but we believe it's controversial just because we've been in an environment which really hasn't changed that much in terms of platforms, new waves of technology. You had PC, you had internet, so that was one, and then one. Now we have five. So we're quite excited about the productivity gains that are going to drive GDP growth forward.
Thank you very much. Very comprehensive. We've probably got time for one more question, and I want to end on this one because I think it could be a really interesting answer. What's your take on AGI, artificial general intelligence? How close are we? Is this something we should be worried about?
Yes, well, if you're Elon Musk, and I've listened to him a few times in the last few days, he'd tell you we're almost there. 2027 is the, but what does it mean? It's I think in his view of the world, at least the early stages of AGI, really going to make us superhuman, super intelligent. We're going to leverage off of it. So, and I agree with that. We agree with that. I mean, I'm astonished. I don't know if you have Grok 3 yet in the UK. I do think it's gone global.
Mm.
But try it out. I am blown away by how much it knows and how well it answers our questions. Our questions tend to be very deep research questions. It's mind blowing. We've got a PhD at our fingertips, and it's how we put all this knowledge together and all of this automation together that's going to determine the kind of life we have in the years ahead.
Yeah, thank you. Sadly, that is all we've got time for. 1 minute overdue, but not too bad. We could have gone all day. It's so interesting. Thank you so much.
Thank
If we
you.
haven't answered your question today, I've seen we've got lots come through. If it's not Cathie specific, then we'll try and get back to you over the next few days. But if you do want to find out more about any of the ARK ETFs, just log on to the Invest Engine app, go to the Browse Investments page, and then filter by ARK. Or you can just click the ARK tile at the top of the actively managed collection, and you'll find all the details there. All that's left for me then is to say thank you so much, Cathie, for your time today. I think that was a fascinating discussion, and I think the audience would agree.
Thank you, Andy. My pleasure.
Thank you to everybody who dialed in today. Thank you all for joining, and I look forward to seeing you all on our next webinar.